One thing I've just learned in my investing journey, and this is probably one of the most important learning lessons in general, is pick your denominator very wisely for how you measure investment returns. It's like, what is your denominator? Is it dollars, or maybe should it be something else? I remember a conversation David and I had with Arthur Hayes, who said, like, if he could pick any denominator of wealth, right, he'd probably pick barrels of oil. In fact, if he could like store enough oil, he'd have like a little oil can around his belt. He said, and just like store his wealth that way. He says hydrocarbons are essentially the denominator, is units of energy, right? So any investment return is just not enough to outperform dollars, not enough to outperform the stock market. You actually have to outperform barrels of oil, or else you're better off like holding energy. Let me ask you the kind of the same question. When you approach investing just in general, is energy kind of your denominator, or do you use something else? How do you think about this?
When I think about what oil is, I think gold is just a proxy. I think about Bitcoin. Bitcoin is just a proxy through the proof of work expenditure of energy. Gold, you have to expend energy to mine it and refine it, and then you have it, you hold it, and there it is. So it is. I think about the denominator. I mean, I live in a dollar country. It's a dollar reserve currency world. And so I consistently have two things in mind. What's the dollar return and what's the real return? And that's, I think, ties back to my initial point that I think most people don't understand what's happening still, which is most people are still assuming dollar equals oil. They're assuming the denominator is the same. And I think they're different. And not even I know they're different. I can show it to you on the charts. I have a chart on my Twitter feed or X feed today. S&P 500 total return since January 1, 2020 in dollars, up 75%. In gold, up 15%. In Bitcoin, down 81%. That chart, it's telling you the denominators are wildly different. And yet, most people are still viewing bonds in particular, but markets more broadly in general, through this lens that the dollar is as good as gold for oil. And demonstrably, empirically, it's not. It hasn't been. And more importantly, the debt load of America, unless we are going to slash defense and entitlement spending by probably 30 to 40% tomorrow, forever, and then deal with what would fall out of that, which would be a worse than the Great Depression, probably times two. There's no way the dollar can stay as good as gold for oil. It can't. So we're watching in real time a breaking of that long-standing relationship of 73 to '03 or '04, where the dollar was as good as gold for oil. And then it broke down for a bit, right? I said oil went to 150 from '04 to '08, oil went from 40 to 150. And then we had the shale miracle, right? We had shale from going at 2010 through, I don't know, 2020, we'll say. And shale reestablished the dollar as being as good as gold for oil again at a higher rate, right? So the new number wasn't, oil didn't trade, 73 to '03, oil trades 15 to 30 most of the time, 20 to 30 most of the time. Post shale, oil trades 50 to 90 most of the time. Really now the number's probably 70 to 90 most of the time. But I can look at shale production and most importantly, in the mother of all shale fields, the Permian, it's flat. It's that U.S. shale's flat to rolling over. And to keep it from rolling over really fast, they need higher prices. But to get higher prices means higher inflation, which is going to blow up the bond market, which we can't abide either. So what's happening in shale, we're basically in the early days of sort of the second round of this dollar equals oil denominator being broken. It was broken in 0405, and then it sort of was reestablished by 1112 by shale, and now it's breaking again. And there isn't a shale fix coming for oil. The fix is, hey, let's all drive electric cars, except there's no chance we're going to have the grid for that anytime in the next 10 years. And that assumes we have the copper for any of that, which is a very low chance anytime in the next 10 years. And that we have the nuclear power base load for that anytime in the next 10 years, assuming we could get the first two sooner than minimum of 10 years. And there's no chance. There's no friggin' chance. So I think we're again in this re-entering this period of time that we last saw in 03, 04, where there's this recognition of, oh my gosh, the dollar is breaking its tie to energy again. What do you own? Well, then gold did awesome. Gold went from 300 to 2,000 in 8 years. That sounds probably about right. 7x, 6x, it's probably about right. And now we didn't have Bitcoin then, now we do. So I think you're going to see that do really well. I think you'll see industrials do well. I think you'll see inflation be sticky and high. I think commodities will do well. But it's when you talk about the fundamental perceptions, that's it. People are still thinking that the dollar and a unit of energy are equivalent, and they're not anymore. They can't be. We're watching the early days of that break down again.
To continue leveling up your crypto game, then you need to get on the Bankless newsletter. It's the world's most popular crypto email and is completely free. Just click below to sign up.